Imagine the bond market as a giant ticking bomb. What happens when the timer reaches zero? Welcome, Financial Sleuths. I'm Alex Bond, and today we're going to defuse the bond default bomb and understand its real impact. Alright, let's break down the basics. Bonds are essentially IOUs. When you buy a bond, you're lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. But what happens if the issuer runs into financial trouble and can't make the payments? The bond defaults. Let's dig into the crime scene. A bond default can occur with corporate bonds, municipal bonds, and even government bonds. The immediate impact? Investors don't get their expected returns, which can be catastrophic for those relying on this income. But the ripple effect goes way beyond that. When a bond defaults, it's like adding a mysterious substance to a fragile ecosystem. Watch what happens. The credit rating of the defaulting entity, be it a company or a country, can plummet. And then, there's the domino effect. One bond default can make investors nervous about other bonds. This can cause bond prices to fall across the board. So, investors start seeking safer harbors, like gold or treasury bonds. And what about the businesses that defaulted? They could face bankruptcy, layoffs, and, in extreme cases, can contribute to economic recessions. Now, let's zoom into the detective lens to see how this can impact a country. When a country defaults, it can cause the value of its currency to drop. This leads to inflation, unemployment, and social unrest. Sometimes it takes years or even decades for a country to recover from a default. Are you overwhelmed yet? Don't worry. It's not all doom and gloom. This is where our financial superheroes come into play. Governments, financial institutions, and even the defaulting entity can work together to restructure the debt, provide bailout funds, or make other arrangements to mitigate the damage. But wait! What can you do to protect yourself from the fallout of a bond default? Being a smart bond investor means being prepared for anything. Tip number 1. Diversify. Don't put all your eggs, or rather, bonds, in one basket. Spread your investments across different types of bonds and other asset classes. Tip number 2. Research before you invest. Keep a hawk's eye on the creditworthiness of the bond issuer. Tip number 3. Consider bond funds. These funds pool together bonds from various issuers, reducing the impact of a single default. Now, a question for you, dear viewer. What would you do if you found out a bond you invested in was about to default? Would you cut your losses and sell, or would you hold on hoping for a debt restructuring? Let me know in the comments below. Now, let's get back to defusing that bond default bomb. Phew! Crisis averted, for now. But remember, understanding the impact of bond defaults and being prepared can make you a savvy investor and keep you ahead of the game. Well, financial sleuths, that's it for today's thrilling investigation into the world of bond defaults. This is Alex Bond, signing off. Don't forget to hit that like button and subscribe for more financial detective adventures. Stay curious, stay vigilant. You've been watching Financial Sleuths with Alex Bond. Join us next time as we crack open another financial mystery.